in monetary policy to occur sooner rather than later, even in the face of an anemic economic scenario. Inflation is the most insidious enemy of capitalism and prosperity, and no central banker, including me or my colleagues, can countenance it, especially not least the women and men of the Federal Reserve System. But tonight I want to talk about a different matter. In keeping with Bill Martin's advice, I've been scanning the horizon for danger signals even as we continue working to recover from the recent turmoil. In the distance, I see a frightful storm brewing of untethered government debt. I choose the word frightful storm deliberately to avoid hyperbole. Unless we take steps to deal with it, the long-term fiscal situation of the federal government will be unimaginably more devastating to our economic prosperity than the subprime debacle and the recent debauching of the credit markets that we are now working so very hard to correct. You might wonder why a central banker would be concerned with fiscal matters. Fiscal policy is, after all, the responsibility of the Congress. It's not the responsibility of the Federal Reserve. Congress and Congress alone has the power to tax and the power to spend. From this monetary policymaker's point of view, though, deficits matter for what we do at the central bank, at the Federal Reserve. And there are many reasons why. Economists have found that structural deficits raise long-term interest rates, complicating the Fed's dual mandate to develop a monetary policy that promotes sustainable non-inflationary growth. The even more disturbing, dark and dirty little secret about deficits, especially when they careen out of control, is that they create political pressure on central bankers to adopt looser monetary policy down the road. And I'm going to return to that shortly in my speech. But first, let me give you the unvarnished facts of our nation's fiscal predicament. 8 years ago, our deficit, our federal budget rather, crafted by a Democratic president and enacted by a Republican Congress, produced a fiscal surplus of $236 billion. The first surplus in over 40 years and the highest nominal dollar surplus in American history. While the Fed is scrupulously nonpartisan and non-political, I mention this to emphasize that the deficit and debt issue knows no party and can be solved only by both political parties working together. For a brief time, surpluses projected into the future as far as the eye could see, economists and policymakers alike began to contemplate a bucolic future in which interest payments would form an ever-declining share of federal outlays. It was a future where Treasury bonds and debt ceiling legislation would become dusty relics of the past. And the Fed even had concerns internally about how open market operations would be conducted in a marketplace short of Treasury debt. Well, that utopian scenario didn't last for very long. Over the next 7 years, federal spending grew at a 6.2% nominal annual rate, while receipts, what they took in, grew at only 3.5%. And of course, certain areas of government, like national defense, had to spend more in the wake of 9/11. But non-defense discretionary spending actually rose 6.4% annually during this time frame, outpacing the growth in total expenditures. Deficits soon returned, reaching an expected $410 billion for 2008. That's a $600 billion swing from where we were just 8 years ago. This $410 billion estimate, by the way, was made before the recently passed Farm Bill and before the supplemental defense appropriation, and without considering a proposed patch, as they call it, for the alternative minimum tax. All measures that will lead to a further ballooning of government deficits. In keeping with the tradition of providing rosy scenarios, official budget projections suggest this deficit will be relatively short-lived. And by the way, they almost always do when they look forward. According to the official calculus, following a second $400 billion deficit in 2009, the red ink should shrink to $160 billion in 2010, $95 billion in 2011, and then it swings to a surplus of $48 billion in 2012. Now, if you do the math, as central bankers are wont to do, you might be forgiven for sensing that these felicitous projections look a little bit dodgy. To reach the projected 2012 surplus, outlays are assumed to rise at 2.4% nominal rate over the next 4 years. That's less than half the rate they rose the previous 7 years. Revenue, incoming money, is assumed to rise at a 6.7% nominal rate over the next 4 years, and that's double the rate of the past 7 years. So using spending and revenue growth rates that actually prevailed in recent years, the 2012 surplus quickly evaporates and becomes a deficit, potentially on the order of hundreds of billions of dollars. Now, doing deficit math is always a sobering exercise, but it becomes an outright painful one when you apply your calculator to the long-run fiscal challenge posed by entitlement programs. And were I not a taciturn central banker, I would say the mathematics of the long-term outlook for entitlements left unchanged is nothing short of catastrophic. Typically, critics ranging from the Concord Coalition to Ross Perot begin to wring their hands collectively over the unfunded liabilities of Social Security. A little history will give you a sense as to why. President Franklin Roosevelt originally conceived a Social Security system in which individuals would fund their own retirements through payroll tax contributions. But Congress quickly realized that such a system could not put much money into the pockets of indigent elderly citizens who were ravaged by the Great Depression. So instead, a pay-as-you-go system was embraced, making each generation's retirement the responsibility of their children. Now, fast forward 70 or so years and ask this question. What is the mathematical predicament of Social Security today? Answer, the amount of money the Social Security system would need today to cover all the unfunded liabilities from now on, what fiscal economists call the infinite horizon discounted value of what's already been promised recipients, but has no funding mechanism whatsoever currently in place, is $13.6 trillion. Not billion, trillion. $13.6 trillion is an amount slightly less than the annual gross domestic product of the entire United States. Demographics explain why this is so. Birth rates have fallen dramatically, reducing the worker-retiree ratio and leaving today's workers pulling a bigger load than the system designers ever envisioned. Lifespans have lengthened without a corresponding increase in the retirement age, which leaves retirees in a position to receive benefits far longer than the designers of the system ever envisioned. And formulae for benefits and cost of living adjustments have also contributed to the growth in unfunded liabilities. Now, the good news is that Social Security might be manageable. While the issues regarding Social Security are indeed complex, it's at least possible to imagine how Congress might find, within a $14 trillion economy, which is the United States, ways to wrestle with a $13 trillion unfunded liability. The bad news is that Social Security is the lesser of our entitlement worries. It is but the tip of an unfunded liability iceberg. The much bigger concern is Medicare, a program established in 1965, the same prosperous year that Bill Martin, as chairman of the Federal Reserve, cautioned his Columbia University audience to be wary of complacency in the storms on the horizon. Medicare was a pay-as-you-go program from the very beginning, despite warnings from congressional leaders. By the way, a man named Wilbur Mills was the most credible of them before he succumbed, as I like to say, to the pay-as-you-go wiles of a woman named Fannie Fox, a stripper called the Argentine Firecracker. But these congressional leaders foresaw some of the long-term fiscal issues that such a financing system could pose. Unfortunately, they were right. I want you to sit tight while I walk